Picture this, you're 22 years old, you just landed your first real job. Direct deposit hits for the first time, and you're looking at more money in your checking account than you've ever seen in your life. Maybe it's $2,800, maybe it's $3,400, maybe it's $4,200. Whatever the number, it feels enormous. It feels like proof that you made it, like the hard part is over. And so you do what every 22-year-old in America has been quietly trained to do. You upgrade the apartment, you lease the car, you go out more. You start buying clothes that match the person you're becoming. You put the rest on the card because you'll pay it off when things settle down. You don't touch the 401(n)A enrollment form because you just started and you need the money right now and you'll get to it later. And here's the thing, none of that feels like a mistake. It feels like adulthood. It feels like finally being able to live the life you work for. But here's what's actually happening in the background. While you're living that life, the most powerful financial force on the planet, compound interest, is silently running a clock on every single one of those decisions. And that clock doesn't care that you were 22. It doesn't care that you didn't know. It doesn't pause while you figure things out. It just runs. And the decisions you make between 22 and 35, not the ones you make at 45 or 55, are the ones with the longest compounding tail. They are the most consequential financial decisions of your entire life. Not because the amounts are the largest, because the time horizon is the longest. A mistake at 22 compounds for 43 years before you retire. A mistake at 45 compounds for 20. Same mistake, more than twice the damage. Today we are naming every major one. And we are doing the math on exactly what each one costs. Not in dollars, but in the compound future those dollars were supposed to build. My name is Slime Johnson. This is Slime's Wealth Academy. Let's go. If you're under 35 and you're starting to realize that your financial life isn't quite where you thought it would be, if you're making decent money but somehow not getting ahead, if you have debt you can't explain and savings you can't seem to grow, make sure you hit that subscribe button and give this video a thumbs up if it helps you out. Because today we're doing something this channel is built for, telling you the truth about early financial mistakes in plain language with real numbers, without shame or judgment, just the math and the map. So stay with me. Part 1. The history lesson, the generation that inherited a broken script. To understand why young Americans make the specific financial mistakes they make at such consistent rates, across such different income levels, we need to go back to 1984. The economy is booming out of the Volcker recession. Reagan's morning in America is everywhere. The S&P 500 is beginning what will become an 18-year bull run. And a critical cultural shift is underway that nobody is calling a financial education crisis because it doesn't look like one yet. In 1984, the average cost of a 4-year public college education, room, board, tuition fees, was approximately $3,800 per year in nominal dollars, roughly $11,000 in today's dollars. Expensive but manageable. A student working part-time in summers could cover a significant chunk without borrowing. By 2024, the same 4-year public university experience costs an average of $26,000 per year. Private universities average $58,000 per year. Total student loan debt in the United States crossed $1.77 trillion in 2023, owed by approximately 43 million Americans. Here's the generational math nobody does. The class of 1984 graduated with minimal debt into a starting job market during the beginning of the greatest sustained bull market in American history. They had time and capital. The class of 2024 graduated with an average of $37,693 in student loan debt into a job market where entry-level salaries have not kept pace with housing costs, into a stock market trading at historically stretched valuations. These two generations did not inherit the same starting conditions, and yet both were handed the same basic financial advice. Work hard, save money, invest for retirement. But here's what most people don't realize. The specific financial mistakes that young Americans make today are not primarily the result of laziness or irresponsibility. They are the result of navigating a radically changed financial landscape with cultural scripts written for a completely different era. The advice you got from your parents, or didn't get, which is its own problem, was calibrated for 1987, not 2024. The housing market, the credit market, the student debt burden, the gig economy, the cost of healthcare, the absence of defined benefit pensions, all of it has changed fundamentally. And the financial education system never updated. That's what we're here to fix. Starting with the mistakes themselves. Part 2, the mistakes. All 7 of them mistake 1. Treating student loan debt as background noise. Here's the single most financially damaging thing most college graduates do with their student loans in the first 5 years after graduation. They treat them as a fixed, permanent feature of life, like a utility bill, instead of as an active, compounding threat that needs to be strategically attacked. According to the Education Data Initiative, the average student loan borrower takes 20 years to pay off their debt. 20 years. For the class of 2024, that means they'll be carrying student debt until age 42 or 43. During the exact window, their 20s and 30s, when compound interest would be doing the most work on their behalf if they were investing instead. Here's the math on what treating loans as background noise actually costs. Average loan balance 37,000. Average interest rate on federal student loans approximately 6.5% for undergrad, higher for graduate. If you make minimum payments on 37,693 at 6.5%, you'll pay approximately 26,000 less in interest over the 20-year term. Your 37,690 debt costs you 63,693 total. But here's the real cost, and this is the one that makes financial advisors put their heads in their hands. Every dollar going to student loan interest at 6.5% is a dollar not going to a compound investment at 10%. The opportunity cost of 20 years of interest payments isn't just the $26,000 in interest. It's the future value of $26,000 invested instead. 26,000 invested at 10% over 30 years, approximately 453,000. You didn't just pay $26,000 in interest. You cost yourself $453,000 in future wealth. The fix: attack the highest rate debt first with any extra cash. Refinance where it makes sense and lowers your rate without surrendering federal protections. Look into income driven repayment for federal loans if cash flow is genuinely tight. But do not treat loan repayment as a passive set it and forget it item. It is the most expensive thing you own. Mistake 2: not starting retirement contributions immediately. This one. This one is the mistake that keeps me up at night on behalf of people in their 20s. Here's the data. According to Vanguard's 2023 How America Saves report, the average participation rate in 401(k) plans for employees aged 25 to 34 is approximately 61%. That means 39% of young employees with access to a retirement account, a free tax advantaged wealth building vehicle with potential employer matching, are not using it. Let me translate that into money. If you're 25 and you start investing $200 a month in a broad market index fund at the S&P 500's historical average of 10.5%, by age 65 you have approximately 1,397,000. If you wait until 35 to start that same $200 a month, approximately $509,000. 10 years of delay costs you $880,000 from $200 a month. $888,000 gone, not because you spent it, but because you didn't start. And here's what makes it worse. If your employer offers even a 3% match and you're not capturing it, at $50,000 salary, that's $1,500 per year of free money you are actively declining. Over 40 years at 10.5%, that $500 per year of refused free money is worth approximately $870,000. You are not just leaving money on the table. You are leaving compounding decades of investment returns on the table. The fix: enroll today. Even if it's 1% of your salary, even if it's $50 a month. The habit matters more than the amount in the early years. Increase by 1% every 6 months. You will barely feel it in your take-home pay, and the compounding effect over 40 years is transformational. Mistake 3: the lifestyle inflation trap. Every raise disappears. This is the one that feels the most justified in the moment and costs the most over time. Every raise, every promotion, every income bump gets immediately absorbed by lifestyle. The apartment gets upgraded, the car gets nicer, the restaurants get better, the wardrobe expands, and it all feels completely reasonable. You earned it, you deserve it. This is what working hard is for. Here's what most people don't realize: this pattern, established in your 20s, is almost impossible to break in your 30s. The lifestyle you build on your first salary becomes the baseline. Every subsequent raise is already mentally allocated before it arrives. According to a salary finance study, 36% of Americans' earnings between $75,000 and $100,000 annually live paycheck to paycheck. Not because $75,000 to $100,000 is insufficient income in most of America, because every increase has been consumed by lifestyle before it could compound. Here's what lifestyle inflation actually costs. Say you're 25 earning $55,000. You get promoted at 27 to $70,000, a $15,000 raise. If you lifestyle inflate the full $15,000, nicer apartment, car upgrade, spending increase, your wealth building trajectory doesn't move. If instead you capture just 50% of that raise, $7,500 per year, and invest it, leaving the other $7,500 to improve your life, that $625 per month invested from age 27 to 65 at 10% is worth approximately $4,370,000. Half the raise, invested for 38 years, $4 million. The other half still went to your lifestyle upgrade. You still got the apartment. You still got the better car. You just also built $4 million on the side. The fix: make a written rule before your next raise arrives. 50% of every income increase goes to investment before lifestyle claims it. Not after you settle into the new income. Before. Automate the transfer the week the new salary kicks in. Your lifestyle grows with your income, just at half the rate. Mistake 4: carrying credit card debt at 24% APR. The average credit card interest rate in the United States as of 2024 is approximately 24.37% APR, according to the Federal Reserve's consumer credit data. That is not a fringe rate, that is the average. And according to the New York Federal Reserve, Americans under 35 carry an average credit card balance of approximately $4,200. That's not a catastrophic number in isolation. It's the interest math that makes it catastrophic. At $4,000 and 24.37% APR, making only minimum payments of roughly 2% of the balance, it takes approximately 16 years to pay off. Total interest paid, over $6,500. Your $4,200 balance cost you $2,700 to resolve. But the real cost is the opportunity cost of the interest payments. Those minimum payments average around $84 a month in the early years. $85 a month invested at 10.5% over 30 years, approximately $214,000. You paid $6,500 in interest and cost yourself $214,000 in future wealth on a $4,200 credit card balance. Here's what's particularly insidious about credit card debt in your 20s. The minimum payment structure is mathematically designed to keep you in the cycle as long as possible. It's not an accident. The minimum payment is calculated to maximize the interest collected, not to help you exit the debt. If you're making minimum payments on credit card debt, you are not paying off debt. You are renting debt. The fix, the avalanche method. Attack the highest rate debt first with every dollar you can spare, while making minimums on everything else. Pay it off. Then close the account if you can't use it without carrying a balance. A credit card you can't pay in full every month is not a credit card. It's a 24% APR loan you keep retaking. Mistake 5, buying too much car too soon. We talked about this in a previous video, but we need to revisit it in the context of early career decisions, because this is where the damage starts, and it's the mistake with the most social pressure behind it. The average monthly car payment for a new vehicle as of 2024 is approximately $735, with loan terms averaging 68 months. For a 23-year-old landing their first real job, a car payment that only costs $450 to $550 a month feels manageable. Almost everyone they know has one. It normalizes instantly. Here's the compound math. $500 per month in car payments from age 23 to 65. Assuming you always have a car payment, which most Americans do, is $252,000 in payments. But the opportunity cost of that $500 per month invested at 10.5 cents over 42 years instead of paying it in car financing interest. Approximately $4,600,000, $4.6 million. Not in car payments, in the opportunity cost of car payments. Now you need transportations, that's real. But here's the thing, a reliable paid off $12,000 used vehicle gets you to work just as effectively as a $40,000 financed one. The only difference is visibility. One makes you look like you have money, one actually builds it. The fix, buy used, buy reliable, buy within your means without financing if at all possible. If you must finance the smallest amount for the shortest term you can manage. Make it a temporary condition, not a permanent budget line. And the moment it's paid off, redirect that payment to investments. Don't lifestyle inflate it. Mistake 6, ignoring your credit score until you need it. This one is subtle. It doesn't feel like a mistake when you're making it because the credit score doesn't feel urgent when you don't immediately need it, until you do need it. And then it's too late to fix it fast. Here's what most people don't realize about credit scores and their compound financial impact. Your credit score doesn't just determine whether you get a loan. It determines the cost of every major purchase you make for the rest of your life. Mortgage rates, car loan rates, insurance premiums in 47 states, even job background checks in some industries. A 2023 study by LendingTree found that the difference between a 620 credit score and a 760 credit score on a 300,000 30-year mortgage is approximately $93,000 in total interest payments. Same house, same banks, same term. $93,000 difference in lifetime cost based entirely on a 3-digit number that you had 10 years to build and didn't. And here's the really interesting part. Building a strong credit score costs nothing. It just requires time and behavior. Pay your bills on time. Payment history is 35% of your FICO score. Keep credit utilization under 30%. Amounts owed is 30% of the score. Don't open too many new accounts at once. Don't close old accounts. That's most of it. Starting at 22 with a thin credit file and consistent on-time payment behavior, you can have a 740 plus score by 28. That score, applied to a $300,000 mortgage at 28, saves you roughly $93,000 over the life of the loan. The fix, pull your credit report free at annualcreditreport.com. Dispute any errors. A Federal Trade Commission study found that 25% of consumers have errors in their credit reports that affect their score. Set up autopay for the minimum on every account. Get a secured credit card if you're building from zero. Use it for small purchases. Pay it in full every month. The clock is running. Start it young. Mistake 7, not building financial literacy before you have money to apply it. This is the one that might be the most structural of all 7 and the one with the broadest compound consequences. Most Americans receive zero personal finance education before they start earning. According to the Council for Economic Education's 2022 survey of its states, only 25 states require high school students to take a personal finance course. 25 out of 50. And even in states that require it, the quality, depth, and practical application of those courses varies enormously, which means most people arrive at their first job with their first real salary, their first 401 enrollment decision, their first car financing decision, their first credit card, with essentially no framework for any of it. They make all those decisions based on what they watch their parents do, what their friends are doing, and what the advertising industry has trained them to believe about money. And advertising, let's be honest, is not optimized for your compound wealth. It is optimized for your present consumption. The financial cost of this is almost impossible to calculate precisely because it's the aggregate cost of every suboptimal decision made in the absence of a framework. But we can approximate. If the average American starts investing at 35 instead of 25, a delay largely attributable to not knowing why it mattered and how to start. The opportunity cost in retirement wealth at 10.5% returns from 200 more dollar is approximately $1,888,000 as we calculated earlier. If the average American carries credit card debt for 10 years in their 20s instead of paying it off aggressively, a behavior largely driven by not understanding the compound cost of minimum payments, the wealth cost is $214,000 as we calculated. If the average American lifestyle inflates every raise, instead of capturing 50%, because nobody explained the 50% rule, the wealth cost is potentially millions. The compound cost of not knowing is measured in millions per person, accumulated silently over decades. The fix, you're watching this video, that's a start. But don't stop here. Read one book on personal finance, The Psychology of Money by Morgan Housel, is the best starting point I found for shifting the mental model. Follow the channels and sources that give you frameworks, not hot tips, and share what you learn. The person in your life who is making these mistakes isn't doing it because they don't care. They're doing it because nobody showed them the map. Part 3, the twist, the compounding of mistakes. Here's the insight ties all seven together, and the one that most financial content completely misses. These mistakes don't just compound individually, they compound with each other. Student loan debt reduces your capacity to invest, which delays compound interest, which means you arrive at the escape velocity threshold later, which means you're in stage 2 longer, which means lifestyle inflation has more time to normalize, which means the race capture becomes harder, which means the credit card debt grows during financial stress, which means the credit score suffers, which means the mortgage costs more, which means there's less cash for investment and the cycle closes. One mistake feeds the next. The compound cost of the full set of mistakes working together is not additive, it's multiplicative. And here's the flip side, which is the message I want you to actually leave with. The corrective behaviors also compound with each other. Aggressively attacking student loan debt frees up cash flow that can go to investments. Higher investment balances reduce financial stress. Reduced financial stress improves prefrontal cortex function and long-term decision making. Better decisions lead to 50% race capture. Larger investment base generates returns that cover lifestyle needs. Lifestyle needs covered by passive returns reduce consumption pressure. Reduced consumption pressure means the credit card balance goes to zero. Zero credit card balance improves credit score. Better credit score reduces mortgage cost. Lower mortgage cost frees more cash for investment. The same compounding mechanism that makes the mistakes devastating makes the corrections transformational. You don't have to fix all seven simultaneously. You have to fix the first one. The one that opens the most cash flow, reduces the most stress, and gives your brain the cognitive surplus to fix the next one. For most people under 35, that first fix is one of two things: eliminating the overdraft credit card cycle or starting retirement contributions immediately. Start there. The system does the rest. Part 4, the present day, what this means right now. Let me be specific about the current environment and why the timeline urgency for people under 35 is actually higher than it's been in decades in both directions. The case for urgency, good news first. If you're under 35 and you start investing today, you have the longest time horizon of anyone in the market. 40 plus years of compounding is available to you that is not available to anyone older. In a potentially lower return environment, and the Schiller Cape at 34 to 35 times earnings versus a 17x historical average does suggest forward returns may be more modest than the historical 10.5%. Your time horizon is the asset that compensates for lower expected returns. Even at 7% annual returns, a realistic conservative estimate for the next decade, $200 a month from age 25 to 65 generates approximately $525,000. The compounding still works. It just requires starting. High yield savings accounts are currently paying 4.5% to 5%. For young people building the emergency buffer, the stage 1 exit we discussed in previous videos, this is the best cash return environment in over a decade. Every dollar in your emergency fund is earning real money while protecting you from the predatory infrastructure. The case for urgency, the uncomfortable part. Housing affordability for Americans under 35 has deteriorated dramatically. The median home price in America as of early 2025 is approximately $407. requiring a 20% down payment of $81,400 and a monthly payment at current rates of approximately $2,100 even with the down payment made. For a household earning $75,000, that's 34% of gross income going to housing, above the traditional 28% guideline. What this means practically: the financial decisions you make between now and when you attempt to buy a home, your credit score, your debt to income ratio, your down payment savings will determine whether homeownership is accessible to you or whether it remains permanently out of reach. Every credit card balance you carry increases your debt to income ratio. Every year of student loan payments reduces the cash available for a down payment. Every point of credit score below 760 adds to your mortgage rate. The compound consequences of the 7 mistakes flow directly into housing affordability. The person who addresses all 7 mistakes by 30 arrives at the home purchase decision with a strong credit score, low debt, growing investments, and real down payment savings. The person who doesn't arrives with damaged credit, high debt to income, no savings, and finds that the window may be closed. The urgency is real, and it runs in both directions. Start early and the compounding works for you. Wait and the very mistakes compound against you. Part 5. The honest take look. I want to say something directly to anyone under 35 who is watching this and doing the math on the mistakes they've already made. The compound math I've described today is real. The opportunity costs are real. The $888,000 cost of starting 10 years late, the $453,000 cost of minimum payment student loan treatment, the $4 million cost of car payment culture. These are real numbers. And they are also not your fault in the way most financial content implies. You are handed a financial landscape: student debt, housing costs, stagnant wages, absent financial education, a credit system designed to extract from you that is genuinely harder to navigate than the landscape your parents faced. The cultural scripts you were given were written for a different era. The financial education you received was either absent or inadequate. That context doesn't change the math. The compound cost of each mistake is the same, regardless of whose fault it is. But it should change the way you carry this information, not with shame, with clarity. The math is not a judgment, it's a map. Every dollar you redirect toward compound wealth from today forward is doing exactly the same work that the dollars you didn't redirect would have done, just starting from where you are, not from where you wish you were. The best time to address any of these mistakes was the day after graduation. The second best time is today. You are not behind in a way that can't be recovered from. You are behind in a way that requires honesty, urgency, and the specific corrective actions I've laid out today. That's a very different thing. Start with the first mistake on this list that applies to you. The most expensive one, the one with the highest interest rate or the longest opportunity cost tail. Attack it with everything available. Then move to the next. The compounding works in both directions. You have time. Use it. Here's what I need you to carry out of this video. The decisions you make between 22 and 35 are not practice rounds. They are not warm-ups for the real financial life you'll live later. They are the foundational layer of everything, the base that everything else compounds on for the next 40 years. Every dollar of student loan interest compounds against you. Every dollar of credit card minimum payment compounds against you. Every raise consumed by lifestyle inflation compounds against you. Every year without retirement contributions compounds against you. And every dollar redirected away from those drains toward investment, toward debt payoff, toward the 50% raise capture compounds for you. You don't have to be perfect. You don't have to fix all 7 mistakes this week. You have to fix the most expensive one you currently have right now today. Because the clock that was running while you were 22 and didn't know any better, it's the same clock that runs when you do know better. The only difference is which side of the ledger it's adding to. You know better now. Act accordingly. If this video made you rethink something you've been doing since your first paycheck, hit the like button. It helps this channel reach more people who need this. Subscribe to Slime's Wealth Academy if you're not already here. We drop financial education like this every week. No jargon, no gatekeeping. Just the real mechanics of how money works and how regular people can use them. Drop a comment right now. Which of the 7 mistakes hit home hardest? Student loans, car payments, the lifestyle inflation trap. I read every single one. And if you've got someone in your life who's under 35 and making these mistakes, send them this. The earlier they see it, the more the compounding works in their favor. I'm Slime Johnson. This is Slime's Wealth Academy. Regular people, real wealth, no gatekeeping. See you in the next one.